evening, members. I welcome you all for this study circle meeting on recent developments in transfer pricing. And to handle this session, we have CA Narendra Jain. Can I request our Vice Chairman CA Narendra to escort the speaker onto dais and then welcome him with floral bouquet. Thank you. Can I request our Vice Chairman to give welcome?
Good evening, members. Firstly, I am glad to see you all. I know it was a very hectic season for us to work on the tax audit, and I think most of you are now relaxed. Of course, now we have the other deadline which is catching up. So what we thought is we will shuffle a couple of programs, and we scheduled today to be the transfer pricing seminar. Generally, we used to have it a one-day seminar, and considering the latest developments and this thing, we felt that probably 2 hours will suffice, where we can gather the practitioners' experience from what has evolved and look into the recent developments. And of late, we know most of our clients, due to the global exposures, some on the other way they are falling into the TCB reporting or a TP study. So I thought we'll take this opportunity to just re-emphasize and look into what we have. And to dwell into this subject, we have CA Narendra Jain, who will take us forward. I would not like to waste further of our time. Welcome you again. Welcome, sir. And I think I would like to hand it over to sir. And I would like our secretary to introduce the speaker before we hand over.
Thank you, Vizi. I have a privilege in introducing CA Narendra Jain. Narendra J Jain is a chartered accountant, is advocate, is a commerce graduate and fellow member of our Chartered Accountant Institute. He is also a company secretary and holds bachelor's degree in law. He currently practices as advocate in Karnataka High Court. Narendra has experience over 19 years in advising clients and handling tax litigation in income tax, transfer pricing, corporate tax, international taxation and GST. His academic distinctions include he has held All India 5th rank in CS Intermediate, DL Mazumdar's silver medal for securing highest marks in Advanced Company Law and Practice in CS Final, Taxman's Prize Award for securing highest marks in Direct and Indirect Taxation Law and Practice in CS Final, Mrs. Pankajan Rangachari SIRC Prize Award for securing highest marks in Advanced Company Law and Practice in CS Final. He has co-authored so many books. Few of them are Analysis of Transfer Pricing Judgments, published by CCH, co-authored another book on digital commerce and analysis of taxation aspects and emerging issues, published by IFA Bangalore Subcharter, co-authored book on permanent establishment emerging trends, published by CTC and Taxman. He has co-authored another book on New Age Assessment, Penalties and Appeals, published by KSCAA. He is a regular speaker at various conferences, workshops, study circles, National Academy of Direct Taxes, etc. His teaching stints include teaching for CA final year students at CAPS on direct taxes, international taxation and transfer pricing from 2004 to 2018, and for CA final year students at ICA Bangalore branch. His professional associations are he is the chairman of International Fiscal Association, Bangalore Subchapter from the year 2023 to 25. He is currently the Joint Secretary of Bangalore ITAT Bar Association. He was convener of Bangalore subgroup of Chamber of Tax Consultants, Mumbai for 2019-20. With this brief introduction, I present before you CA Narendra J Jain. Over to you.
Dear professional colleagues, seniors in profession, good evening everyone. Good evening. Thank you Bangalore branch, Vice Chairman Pramod Ji and Secretary Manjunath for giving me this opportunity to present my views on transfer pricing, recent developments and transfer pricing. and as always, it is a pleasure being here. It is a lot of learning experience when you make a presentation. In next 1 hour 45 minutes, roughly 2 hours, we'll try and see what are the recent developments in the field of transfer pricing. If you see the legislative changes, they are not much. There has been a stability in terms of provisions at least. However, from the practice perspective, from the practice in terms of, because it's going to be a season where everyone has to file the TP certificates from 3CB, also comply with the TP study requirements, and a lot of other related activities are also there. We'll try and see some recent developments which are relevant for this particular thing. So I have split the developments in 4 parts. One is the recent circulars or notifications which are there relevant to TP. Then statutory amendments which have been done in 2023 Finance Act. Certain recent judicial decisions, couple of them which are very relevant both from the study perspective and assessment perspective. And what are learnings in recent assessment which the department has conducted. So those learnings help us to improve our TP study, at least try not repeat those mistakes maybe when we do the current year study. The transfer pricing arena, which almost now 2 decades we have, right from 2002-3 assessment year started. In the initial phase, the department also learned, we also learned. Then there were quite a few amendments, quite quick amendments happened in the provisions. If you see up to 2009, 10, 12, continuous changes were made in the provisions. Then later on we found out that there is a huge amount of litigation in the transfer pricing which is coming up. So government tried to bring in different set of dispute resolution for resolving those disputes. They brought in DRP provisions in 2009, Dispute Resolution Panel. Some of the decisions we will discuss today, I've seen how it has not worked as efficiently as government would have possibly thought in 2009, and in fact led to certain new disputes. So dispute resolution was brought in, safe harbor was brought in, then APA was brought in, MAP was anyway there under the treaty provisions. So there has been an effort to try and see that the disputes related to transfer pricing are reduced. In terms of documentation, because of the global mandate, the BEPS project, Base Erosion Profit Shifting projects, in 2016 onwards we saw a lot of amendments. 2016 onwards, the CBCR reporting the master file report. Post that we have not seen much of the statutory amendments which have happened in the statute. So there are one set of compliances that come from the basic statute we have, 92D documentation requirement, 3CEB TP certificate requirement, and another set of documentation kicks in if you are beyond a certain size. The master file requirement kicks in if the consolidated turnover is more than 500 crores, plus 50 crores of international transaction. CBCR is at a much larger for a much larger companies. So these are the whole gamut of things that one has to comply in this month of October and November, and see what is relevant for each of the companies. If you see the dispute part is also there, except for APA, which has had a good momentum in last few years, and a lot of agreements were signed by the board in that particular area. Other disputes have had its own share of difficulties, and we'll try and see those issues which are there. So first we'll see what are the recent changes, via statutory and other changes. If you see 92 CB, safe harbor margins. Now safe harbor, again, it was brought in with an objective to reduce tax litigation in the transfer pricing field, and certain set of margins were prescribed. The idea of safe harbor, as we all know, was that if you comply with the safe harbor margins prescribed in Rule 10 TA onwards, then there will be no transfer pricing assessment in those cases. So a basic check is done, which is provided in the provisions itself, and post that there is no further requirement of a detailed scrutiny which happens in the normal cases. Like a reference to TPA would happen under 92 CA for normal cases, that would not happen in a safe harbor cases. So safe harbor margins from 2017-18 onwards. Originally it was brought in before that, 2014 onwards, 2012 onwards. And in the initial phase, the margin was at a higher level. So there was not much people who really opted for safe harbor. So it was we can say phase 1 was sort of a failure. You don't see many people trying to say opting for it. For example, the software development margin on a cost plus was 20%. So really the IT companies thought, why should I go for a 20% margin when I can get a very favorable decision at the tribunal level for a much lesser margin. Plus 20 may be agreeable from Indian perspective, but when you look at from the other countries' perspective, suppose you are rendering services to the US, whether the US tax authorities will be ready to say that so much of payment going to India, whether it is at arm's length. So those were the difficulties. Even 17-18 onwards, they had particular committee formed, and that committee's report was placed. And then they came up with a new set of rules under Rule 10 TD 1A. And that rules provided certain reduced margin. So what it provided? It provided that for software development segment, it is 17% up to 100 crores of turnover, IT is 17% up to 100 crores of turnover. And if you cross 100 crores, you are up to 200 crores, you maintain a margin of 18%. These margins are on cost. So your operating cost plus 17 or 18%, you are good. So you have a cost, you have 100 rupees of cost. If you bill 117 minimum to your associated enterprise outside India, these are for services rendered to a foreign associated enterprise, then it is sufficient and there is no requirement for any further scrutiny in those cases. So a lot of companies which are in the initial phases, those are small companies which generally come asking us what should be the margin for these companies in the initial phases at least. This is a good benchmark which anyone can adopt, that you can take the 17%, 18%, slightly different margins for KPO based on the employee cost. Certain more margins have been prescribed, auto components, core auto components 12%, other 8.5%, certain for interest and corporate guarantee. So these are the margins prescribed in the safe harbor regulations, Rule 10 TD. Now in the initial phase, these margins were prescribed for 3 years. From assessment is 17-18 onwards for the 3 years. The idea at that point of time that economic circumstances may keep changing in every few years, therefore a study needs to be done, and therefore at end of that possibly a different margin will be prescribed. After that maybe a revision in the margin will be done. However, that has never been done. After 17-18, every year they keep on extending the same margins for another 1 year. So they have again come up with one notification in August 9 of 2023 saying that the same margins which have been prescribed earlier will also be applicable for assessment year 23-24 on 23-24 also, not onwards, just for 23-24 onwards. So this is what has been prescribed. Pretty simple, no much of issue, but practically prescribing this every year is what doesn't look business friendly. Doesn't look from a business perspective. The margin is prescribed after the end of the financial year. People would have already billed whatever their invoices need to be raised, and it has been prescribed 4 months after the end of the financial year. Again, you don't know what is the margin for next year, whether they will reduce or whether they will keep the same. If you really want to keep the same, why not intimate the assessee in advance that this is the margin which has been prescribed? At least that helps everyone to plan their affairs accordingly, pay their advance taxes and other things in proper manner. But however, it may as it is what the government thinks fit. But in that context, this is what has been that the safe harbor margins have been extended for 1 more year. The same margins have been retained for another 1 year. Hopefully, a better sense will prevail and we get better notifications either earlier in the years or at least a better study where more segments can be used. See, if you see safe harbor, no doubt these margins may be at a slightly higher level than what the arm's length margins have been accepted otherwise. But it gives certainty to the assessee that this is what, there will be no further scrutiny of this. Another drawback in the provision is that when it comes to 92D documentation, that is a TP study report which the assessee has to maintain, has prescribed in Rule 10D, that has not been done away with when you opt for safe harbor. Ideally, when you opt for safe harbor, there should be a restricted documentation requirement that to satisfy whether you have satisfied the condition of 92 Rule 10 TD or not, that is what should be seen. There is no requirement to go into further details. So if they really prescribe the margins early, prescribe a better margin with more number of segments or industry segments covering that, do away with maintaining TP documentation even in safe harbor margin cases, then really people for associates to opt for it, you will see more and more associates opting for it. Otherwise, the compliance burden remains same today, and still why would associate want to have a higher margin? That is the problem with the safe harbor margins. Another point that one has to keep it in mind with respect to safe harbor margin is, once you file the form with respect to safe harbor margins, 3CEFA, after that there is a limited time available for the revenue to check those particular margins. So there is a computation mechanism given in the rules. As per that, if I have computed or not, that is a limited test that the assessing officer or the TPO has to do. So within 2 months, the assessing officer or additional 2 months by the transfer pricing officer is what he needs to evaluate and see whether the assessing's margin are as per safe harbor margin or not. If approximate 4 months have lapsed after you filing the return of income, in those cases there is no further opportunity for the officer or the revenue to check at that, and it should be deemed to be accepted. So there are another cases where associates are really already having say more than 17% margin. If they want to opt for a safe harbor margins, the associate should file the relevant form. It is a physical filing of form. There is no online filing provision for this particular form. So this has to be done, and it should be done before filing the return of income, and one should comply with it accordingly and take the benefit of it if in a particular case the associate is eligible. Another contentious issue which was there is the arm's length range concept. As we have seen in the TP provision, there are two set of arm's length range. One is the median concept and one is the arithmetic mean concept. So if you have 6 or more companies, then in case of RPM, CPM, P and MM, you can adopt the median interquartile range. That is, if you arrange your comparable set in the ascending order, the 35th percentile to 65th percentile becomes the interquartile range, and the median is the middle point, 50th percentile. So that is what is the normal computation if the comparable number is 6 or more. So that is a statutory recognition in Rule 10C itself. There is no separate notification required for that year on year. It is prescribed in the Rule 10C itself. Now in cases where the comparables are less than 6, suppose you have 2 comparables or 3 comparables, then the concept of arithmetic mean and arm's length range kicks in. So section 92C read with Rule 10CA provides that if you have less than 6 comparables, say you have 5 comparables or 4 comparables, in that case the arithmetic mean becomes the arm's length range. Arithmetic mean becomes the arm's length range. Now the deviation from the arithmetic mean, how much deviation is permitted? Suppose your price is 102 and your purchase price is, say for example, 102 and the arithmetic mean is 100. Now there is a difference of 2 rupees. Whether that difference of 2 rupees should be added to total income or not. So that is where the range concept comes in. The rule 10CA provides that the range for arithmetic mean will be prescribed by the board. And that prescription earlier, before this change in the rule in 2014, prior to that, the range concept was envisaged in the section itself. Section itself provided 5% range, which was then deleted, and then it was brought in the rule, and rule gave power to the board to prescribe the arm's length range. So the 3% range has been prescribed 2014 onwards in normal cases, and 1% range has been prescribed in cases of wholesale trading. So if the activity is wholesale trading, then the arm's length range is 1%. In cases it is other than wholesale trading, the arm's length range is 3%. Unfortunately, this also requires notification year on year. And from 2014 onwards, every year they notify same range. There is no change except the notification number and date of notification. There is no change. And this notification also again comes post the end of the financial year, which is also not a very healthy practice. But anyway, the same range which was applicable for last 5-7 years has been extended for the assessment year 23-24 also, and provided 3% range in normal cases and 1% range in the case of wholesale trading. Now wholesale trading is also defined in the notification, where it provides that if it should be naturally trading activity, purchase cost of finished goods, it should be is 80% or more of total cost pertaining to such trading activity. So if my total cost is 100 and purchase cost is at least 80%, so it is 85%, then one condition is set. Both the conditions are cumulative conditions. Then the range and the second condition is average monthly closing inventory of such goods is 10% or less of sales pertaining to such trading activity. So we have to do an average of monthly closing stock, and if it is less than 10% of sale, if my sale value is 10 and this average is, my sale price is 100, the sale of the goods is 100 in that particular year, and if my monthly average inventory is less than 10, so it is 9 say for example, then the cumulative condition will be satisfied. And then the range will be 1% and not 3% in normal cases. If I do not satisfy this condition, any one of these conditions also, then the range will be 3%. So assessee can opt for 3%. In case of other cases like service, manufacturing and other all cases, the range is 3%. There is no even need to even check for this. Only in cases where the wholesale trading activity is involved, in those cases the range will become 1% instead of 3%. The logic for this is, or the reasoning for this is, in a trading activity, generally the margin is much lower, and when you do a wholesale trading, the margin is much lower. So your GP or NP in those cases itself may be 1 or 2% or 3%, not more than that in most of the cases. So therefore, providing a higher range of 3% did not make sense. So therefore, they provided a restricted range of 1% in those particular cases. So these are certain notifications what we have got in recent times related to transfer pricing. Then just to understand what is happening at the assessment level, and then we'll go to legislative changes, and then we'll go to judicial changes. Now in the assessment level, from a Bangalore's perspective, these are certain important category of assessment that is happening at the Bangalore level. Because Bangalore predominantly we have these, if you say these particular items or these particular issues will cover mostly 80% of the cases that we have in Bangalore. So what happens is we have a particular method of doing the assessment by the assessing officer, by the transfer pricing officer. So as we all know, there is a mechanism to refer the case from the assessing officer to TPO. That section 92 CA provides that the assessing officer, if he feels it is necessary and expedient to do so, he will refer the case to the transfer pricing officer. There is a transfer pricing officer who handles the transfer pricing assessment. Now if you see the transfer pricing officer, this is again a physical assessment, it is not a faceless assessment. Again, transfer pricing and international taxation both remain as a physical assessment. They are not a faceless assessment. Right? Now they have recently concluded assessment for year for 2021. Now if you see the median, so we'll analyze these in two categories. One, what is happening at the department level, and what is happening at the tribunal level for these cases. The High Court and Supreme Court is a separate aspect, I'll come to that. But at a department level, when it comes to software development segment, generally this has been the range of median they have adopted. And generally because the comparables are 6 or more, therefore they have adopted a median concept, not the arithmetic mean concept. So in the case of software development, they have generally had this range of 23 to 24%. You'll be surprised to see that this is a similar number that they have arrived in most of the years in last 15 years. Except 1 or 2 years here and there, but most of the cases in last 15 years, you will see that the assessing officers have adopted transfer pricing officers have adopted a similar approach, where they have come up with a set of comparables. Very similar companies have been coming in last few years, and their approach in terms of assessment, their approach in terms of TP assessment has been very similar in last few years. There is no change for 2021 as such. The number is there 23.56%. Now, similarly for ITES, we will see that they are again at a similar range of 23-24%. Marketing support, if you do a marketing activity where you provide a support, marketing support activity, they have generally had a margin of 19 to 20%. So if you see these three segments, which cover majority of cases in the Bangalore jurisdiction, this has been the arm's length median which the assessing officer have considered. Multiple issues that comes up to mind. When the safe harbor itself is 17%, when they have signed the APA, advanced pricing arrangements at a similar rate of 17 or 18%, why do officers still continue with a higher number of 23 or 24%? This is one of the issues that certainly comes up in mind. And if we take this forward to say DRP or tribunal, we have seen that these margins, with the higher margins which the assessing officers assess, the transfer pricing officer assess, have not been sustainable. The tribunal have generally given a much lower margin after inclusion of certain companies or exclusion of certain companies. We need not go into the specific which company gets included or which company gets excluded. But the main point is, even companies with a cost plus markup of say generally 15 to 16% having no difficulties in getting a fair order from the tax tribunal. So this has been the similar thing which has happened in last so many years. Very similar issues have also happened in this year also. Same concepts which we have a judicial decisions and judicial decision in assessor's favors, the revenue still continues with a similar margin. The problem lies in the fact that at a higher level, at the High Court and Supreme Court level, there is no closure to these cases. So earlier cases where suppose a company has been excluded, for example, just take a software development segment, they have included companies like Infosys, etc., which are very large companies when compared with the captive companies, right? The tribunal has consistently held that these large companies cannot be compared with the captive companies. We have Delhi High Court in Agnites case and various other decisions which have taken a similar view. But still the transfer pricing officer continues to take these companies in the part of the assessment proceedings. And when that happens, naturally the margin that they arrive is much higher. Now when you go to the tribunal, if these companies get excluded, the margin naturally comes down in the median, that is a 35th to 65th percentile interquartile range that we get, will be such that even a company with a cost plus 15% markup should be easily through with this. So their assessments have only helped professionals like me who has got more work because of they are doing the additions. But ultimately the government really has not got any benefit out of these. So there is a sense of urgency required in similar matters that at the High Court level, at least if we get closure on these issues and some principles are laid down, then you will find that the authorities maybe at the below level follow it. And there is, or at least from the government side intervention is there and a similar pattern which is there. And when the government itself is prescribing 17% in safe harbor and similar 17 and 18% in APAs, then why not accept these in the transfer pricing proceedings also? So these are some aspects which are there. Their approach has been very similar. One important issue came up before the Supreme Court in SAP labs, SAP labs. The question was, the Karnataka High Court had held that in SoftBrand's case, had held that in a transfer pricing issue, the tribunal is a last fact-finding body, right? You can only go to High Court if there is a substantial question of law. And in a transfer pricing matters, where there is a question of whether company A is comparable to assessee or not, company B is comparable to assessee or not, these are only matters of fact. These are matters of fact or question of fact, and these do not raise any substantial question of law. So the High Court held that these do not raise substantial question of law, and finding of tribunal should be considered as final in these matters. However, the tribunal took these matters to the Supreme Court. It was a very large matter of 170 cases before the Supreme Court. Supreme Court laid down the principle that you cannot say that in every case there is no substantial question of law. The High Court in each individual case should analyze whether there is a substantial question of law. The High Court held that the Supreme Court held that not selecting comparables as per the provisions of 92C or not applying a proper filter or not, that also could be substantial question of law. So now all these matters are again piled up before the High Court, and High Court has to re-decide whether this really results in a substantial question of law. And unless these batch of cases, unless similar cases which are pending before various High Courts across the country are disposed, we really do not get certainty in these matters, and which really is a cause of a concern for every company which is there in India in a similar business segment, because these issues are recurring issues which keep on every year. So this is what is happening for at least for these three segments: software development, ITS and marketing segment. Then comes the interesting aspect of notional interest on receivable. Now when you render services to your associated enterprises, the services are rendered. There might be situations where the receivable, that is the amount which you have to receive from your associated enterprise, there is a delay in getting that amount for certain reasons. Now the agreement may provide for a time limit or may not provide for a time limit, that within what period you should really get this money, right? In 2012, the Finance Act 2012 made an amendment to the definition of international transaction. They inserted an explanation 1 to the definition of international transaction. There they said that the deferred receivable is an international transaction. Before that, the courts were taking a view that Cox and Kings and Indo-America, other cases, they took a view that receivable is not per se a separate transaction. What is a transaction? It is a sale transaction. Receivable is just emanating from that sale transaction. It is not separate from sales. So if I render a service and I have to receive money, rendering service and receiving amount is not two separate transactions. It is interconnected transaction. It is a single transaction. You should not bifurcate this. Now, how you analyze a sale transaction is, naturally if you give a larger credit period, you would want a higher sale price. That is a basic business commercial sense or prudence what we say, that if I give goods on credit, I will want to charge more vis-a-vis the goods sold on cash, which is factored in my sale price itself, Any normal business person would try and do it, right? So before 2012, the courts also accept that particular view and they said receivable is not a separate transaction by itself. However, post the amendment, there are some difficulties which have come. So there have been too many divergent views on this particular aspect. Their courts in all directions have been taking different views. So one issue is whether receivable is really a separate transaction or whether it is a part of sales. If you see Delhi High Court in Kusum Healthcare's case, where this was one of the issues they dealt with, and the associate computed the arm's length price applying TNM, transactional net margin method. And while calculating transactional net margin method, the receivables were factored in by doing a working capital adjustment. What we do a working capital adjustment in transfer pricing area, we will see that it compares the working capital level, inventory, receivable and payable of the assessee vis-a-vis the comparable. The OECD has given a particular methodology to calculate that what is the difference in working capital and how it affects the net margin. So when you do a working capital adjustment which factors in the receivable, payable and inventory of the assessee vis-a-vis the comparable, really the difference in level of working capital of the assessee and comparables is factored in. The Delhi High Court said that look, the receivable already gets factored in the net margin itself. There is no separate adjustment required for the receivables. However, tribunal still continued with their different approach and they said receivable is a different separate transaction despite Delhi High Court being in favor of the assessee. Various other tribunals took a view that receivable is still a separate transaction. It needs to be benchmarked separately. Reported separately. All that needs to be done. So if you see in Bangalore also, the tribunal has taken a view that receivable is a separate transaction because of 2012 amendment, and there is a conflicting view on the working capital, but they said otherwise you should receive the money within a defined period, within a reasonable credit period. What you can give is a reasonable credit period for the EE. If you give a long credit period for the EE, so if you render services and don't receive money for a year, then naturally there is going to be a problem. What really had to be seen in these cases, that if I render services to AE, I have a receivable of say X amount from my associated enterprise, whether I have received in a similar time what I have received, what the comparables would have received in a similar time, right? If I render services to third parties and I receive that money in 90 days, I should receive from the comparable within 90 days itself. In a captive, you may not have an internal comparable, but one will have to fall back on the external comparables to analyze this. The current trend of revenue has been that they don't go into these aspects, that what is the receivable of comparable. They just take an ad hoc figure of 30 days in most of the cases, saying that this is the reasonable period. If you don't receive the money within these 30 days, any credit period excess of these 30 days will be, notional interest will be charged on that credit period. So for number of days, you receiving say 120 days, 30 days minus on that 90 days, LIBOR plus 450 BPS for that particular year is generally taken and an adjustment is made for the total income. The tribunals have been slightly relaxing this. They have said 30 days is not sufficient, it will go to 60 days or 90 days. LIBOR plus 450 BPS is on higher side, it should come down to say LIBOR plus 300 BPS. But this is one of the burning issues which will come up in the TP assessment. So if you are assessees where you are doing documentation, please take care that if there are receivables, something which the assessee should be aware that whether the receivables have been received in time or not. If they have not received in time, adequate disclosures or the TP study should try and see that whether a proper disclosures are made for that, proper reporting is there, proper computation is there for that particular aspects. Otherwise, this is surely something which an addition may happen at the level as if and when the case comes for the transfer pricing assessments. Management fee has again management fee or royalty. These have been a similar issues from last many years, not much of a change in these cases. On an ad hoc basis, they say that no benefit is received. The payment made for management fee is not. There is no benefit received by the Indian company. Therefore, we compute nil. Tribunal has time and again said you can't make it nil, and in those cases they have not accepted the methodology adopted by the assessing officers, by the transfer pricing officer. Two important aspects that we have to keep in mind here. One, we have a safe harbor provision. In a fit case, please use it. It is called as low value added services, and the statutory provision provides that if the low value added services are rendered by A to the assessee, and if they charge cost plus 5%, then it is at safe harbor. Now, no doubt the services are defined there, and you have to fall in the category of the services there. So, back office services, certain managerial support services, those aspects are there in the safe harbor. So, in a fit case, if the services fall in the category defined in Rule 10TA, then in those cases one may try and see whether one can use the safe harbor regulations for that purposes. Second, if the services are of the nature, you see, if they are pure management services, then it becomes difficult to aggregate it with other transactions. The Punjab and Haryana High Court has held that if the services are such, if the transactions are such, that it is like a bundle, and we will see that more as we go in one of the cases of Star India. If they are a bundle, if it is one and you can't segregate it, and one is dependent on the other, and the price, it is like you take leave it or take it. So either you take all or leave all. You can't pick and choose. So many a time the transactions will be such that you have to take everything. Suppose you want to make a royalty payment for technology. It may come with an obligation to buy spare parts from the same person who is providing you the technology. Or it may have other connected, interlinked transactions. In those cases, one should analyze whether the aggregated approach should be adopted or not. Various decisions of Bangalore Tribunal and High Courts have accepted this aggregated approach, and in a fit case, if there is a linkage between transactions, this can be accepted in other cases. AMP issue is pending before the Supreme Court. Delhi High Court held that AMP applying the bright line test, that is the excess marketing expenditure. So what was happening is, lot of large MNCs spend a lot of money on the marketing activity, which creates a brand, and that brand is really owned by the foreign associated enterprise. So Sony's case, for example, brand is really owned by the Sony Japan, but the marketing activity happens in India, and the recognition for the brand is built in India. The Indian company is not the legal owner of the brand. It is only an economic owner of the brand, not a legal owner of the brand. So the question was, why do Indian companies do marketing and brand building exercise for a brand which is of the associated enterprise? The assessor's natural argument was that because of this brand building exercise, advertisement, there is a sales which is happening in India, and that sales is what is generating profits to me. Right? Without this advertising and marketing activity, I really would not have sustained in India itself. Sony's case in Delhi High Court and subsequently various decisions, Whirlpool and other cases, they accepted this argument, saying that you can't segregate the marketing expenditure from the P&L. It is a part of P&L, it is a part of the margin computation. Para 101 of Sony's decision. So they said it has to be aggregated with other decision, but because the matter is still pending in the Supreme Court, the revenue authorities at the lower level still continue with the similar approach. Bangalore Tribunal in various cases, Epson, etc., have continuously held that Sony's decision has to be followed and it is a correct decision. So these are some of the issues where assessments happen on a regular basis. One should be aware of these issues, I thought, and it could be helpful. Then let's go to the certain legislative amendments. Now 92D, as we all know, provides for TP documentation. Read with Rule 10D. And as we know, Rule 10D prescribes that what are the documents the assessor should maintain. In a business sense, we call it as a TP study. And what should be part of the TP study? It will provide various things like business profile of the company, business profile of the group, organization structure, shareholding pattern of the assessee, industry overview, functional analysis, economic analysis, comparability analysis, then the adjustments if any, and computation of arm's length price. These are the broad items which should be part of the TP study. And as per the rules, we do two things in transfer pricing. If you see TP certificate, everyone promptly files it because it has to be filed it online, right? Now, TP study certificate also be certified that the assessee has maintained the TP documents. TP study as prescribed in Rule 92D. If you see the certificate, the second paragraph that says the assessee has maintained the TP documentation. Generally, there have been cases, at least some of the cases, where assessees do not maintain this TP documents. And the thought process is, if it asked in the assessment, we will see it at that point of time. Why should we do it now only? Right? Now, the time limit, if the case gets picked up for the scrutiny, the AO refers to the TP or AO himself does the assessment. Section Rule 10D3 said that the assessee should provide, 92D3 provided that assessee should submit this TP study within 30 days to the transfer pricing officer or the assessing officer. The proviso thereunder provided additional 30 days. So, assessee had 30 days to end plus 30 days, max 60 days, within which the assessee had to submit this TP study document to the transfer pricing officer or the assessing officer. Now, generally the mindset was the 60 days is sufficient time, I will do the TP study at that point of time. The section has been amended by 2023 Finance Act. The time limit of 30 days has been reduced by 10 days. They give two reasons for this. Reason one, they give that the time limit available with the transfer pricing officer is very limited, within which time he has to complete the TP assessment. So, giving additional time means it will reduce the time of the assessee. Giving additional time to the assessee would mean that the time available with the transfer pricing officer will reduce. One. Second, they say this is document which anyway the assessee has to maintain. The 92D1 uses the words keep and maintain. Keep and maintain. That means when you file the return of income, before the due date of filing the return of income, the TP study, before you file tax audit report and 3CB actually, you should have the TP study with you. And therefore, if the assessee has to keep and maintain while filing the TP 3CB itself, that is at the time of filing the 3CB, then what is the difficulty in filing when the notice has been issued? So they give these two reasons and reduce the time limit which is provided in main section from 30 days to 10 days. They reduce the section from 30 days to 10 days. Interestingly, the time limit in proviso, which was also 30 days, has been left untouched. So earlier it was 30 plus 30, 60. Ideally, if they change the main provision, they should have changed the time limit in the proviso also. Or it should have been other way around. The main section would have given 30 days, proviso should have given 10 days. Now the initial time limit what the TPO can give you to file is 10 days. But if you go and ask an extension, he can give you additional 30 days. So that is discretionary. The provisos, the time limit in the provision actually is discretionary. The officer may give, may not give. The point what I am trying to say is, there is a limited time limit now with which the notice will be issued. The notice will be saying that you have to file the TP study within 10 days, right? The penalty for not maintaining TP study, that is the documentation requirement under Rule Section 92D read with Rule 10D is 2% of the value of international transactions. So if your international transaction is 100 crore, the penalty is 2 crore rupees. The professional fees for maintaining TP study is much lesser naturally, right? So the relevant point here is that assessee should be aware, or at least made aware, that this is a requirement which is statutorily there. Have a study along with the certificate ready by the time you file the certificate, by the time you file the return. Because at a later point of time, if the officer asks, and then you really want to do a study, if the case gets picked up for scrutiny and referred to the TPO, the time limit available will be 10 days. And there could be situations where the penalty may be levied if the assessee does not comply with those notices. No doubt we all will have stories to say that why I did not file in time. There was a Supreme Court decision which says we may have 101 reasons for not levying the penalty. So we may have 101 reasons saying why I delayed in filing the TP study, but something which one will have to be aware at least that this is a requirement under the statute, that there is a 10 days time limit which is reduced from 30 days, and within 10 days if the notice is issued, the study should be filed. This is one of the amendments which has been made by 2023 Act, Finance Act. Is a recent amendment. We have not seen as such the implementation of this, but you see notices with a limited time limit already. Then we have change in the definition of specified domestic transaction. Now, as we all know, again 2012 Finance Act brought in the specified domestic transaction in the statute. The section originally covered various items, 5 items. If you analyze it, basically 3 items. One was the payment made to relative 48(2), which was later on deleted from the 92PA definition. Then 2 kinds of transactions basically remain, that is where you are claiming any tax holiday. For example, it could be a 10AA SEZ unit, or it could be a chapter 6A deduction, profit linked deductions under chapter 6AC, profit linked deductions. If you are claiming any of those tax holidays, and 2 circumstances which are covered. That means if the transactions of that assessee who is claiming the tax holiday with another related concern is arranged in such a way that profits of the tax holiday undertaking is higher, then the provision would say that we will not give you deductions under chapter 6A for the higher profit. It is very natural. See, it's very logical, and one of the principles of tax planning is you pay tax where the tax rate is lower. So if I have an option of selecting a 30% tax and 20% tax, any prudent person would naturally select a 20% tax. So therefore, if I have 2 undertaking and one undertaking is a profit holiday undertaking, then I would possibly try and see that the profit in that undertaking is higher, right? So that would be the normal tendency which the assessee would have. Therefore, the specific domestic transaction provisions try and curb that tendency, saying that if you are a tax holiday undertaking, the profit of that undertaking should be on arm's length basis if you have transacted with certain closely connected persons or related parties. So that is the genesis of this particular provision. 2 provisions have been inserted, one 2 years back and one current year. If you remember, we had 115 BAD where a manufacturing concern gets a 15% concessional tax rate if it starts the manufacturing activity within the defined time. That concessional tax rate of 15% was extended to cooperative societies also, manufacturing cooperative societies, where you get a concessional tax rate of 15% if the conditions of 115 BAE are satisfied, that you start within so and so date, with the cut-off date. Now, if that condition is applicable, that condition means that assessee is there who is a cooperative manufacturing society who gets a 15% tax rate. In those cases, the profit of that cooperative society, if it comes within the ambit of 115 BAE4, what 115 BAE4 provides is that if the assessing officer feels that owing to close connection between the assessee to which this section applies and any other person, or for any other reason, the course of business between them is so arranged that the business transacted between them produces the assessee more than the ordinary profits. So it produces more than the ordinary profit for a concessional tax regime undertaking. So I am getting 15% and my profit should have been IT say X, now it is more than that X. And because of that, then it falls in 115 BAE, and if that transaction is more than 20 crores, then the SDT provisions will trigger and assessee will have to comply with 3CB and TP documentation in those cases also. That excess profit, so arm's length, suppose this manufacturing entity is cooperative society or manufacturing company is selling it to a related party and making say 1000 rupees extra profit. So it should have already sold at 10,000, it has sold at 11,000. Therefore, the profit is jacked up by say 1000 rupees, and that 1000 rupees is not eligible for 15% concessional profit rate of tax. That will straight away be taxed at 30%, not 25%, or not say if it's a company, because you have a 25% is the standard rate. But if you are jacking up your profit more than ordinary profit by transacting with your related party or person who has a close connection, that excess profit which becomes taxable at 30%. And this is what the provision provides. And how do you compute that more than ordinary profits? You apply the TP provisions to compute more than ordinary profits. So this is the amendment which has been made in STT provisions by Finance Act 23. And one is again, this is something which one has to take care in the compliances. So these are 2 statutory amendments which have recently been done in the transfer pricing provisions. Then we will go to certain recent interesting decisions, and what learnings we have from these decisions which we can try and see how it can be implemented in our practice in terms of TP certificate, TP study, etc. The first decision which one needs to look at is the recent decision of special bench, 3-member special bench, Mumbai Tribunal, in the case of Star India. As we all know, Star India is into business of media and broadcasting. So before the restructuring which is discussed, or the facts which are discussed in this particular case, the Star main entity is in US, right? ESPN Star Sports, which is based in US, ESS. Now it has a branch in Singapore, and that branch in Singapore does generally the Asian regions broadcasting media rights are held by that branch in Singapore. Now prior to this case, prior to this shifting which has happened in this particular case, the Singapore branch was holding the media rights. The telecasting, everything used to happen by the Singapore branch, and the advertisement revenue used to go to the Singapore branch. So suppose what ads we see today, the revenue used to go to the Singapore branch. There was entity in India which used to do the marketing activity. That means doing all the marketing related to the media rights and getting the advertisement, and it used to get a 15% commission on that particular marketing activity, which was held to be at arm's length by various decisions. Also attribution was accepted in those particular cases. They have changed the business model as we see from the assessment year 13-14. The media rights which were held by Singapore branch of the US company have been transferred or purchased by the Indian company. There is a company which has been set up in India which has purchased these media rights, and the decision is everything about that media rights and how it has been benchmarked. And in that process, there is a good discussion when CUP should be applied, when other methods should be applied, what is the significance of other margin-based methods, which has a priority, which does not have a priority. All that has been discussed in this particular decision. I'm just giving the factual background so that when we go into the real decision, we understand this. So then, those media rights, which included various things, like for example, the Cricket World Cup, Champions League T20 cricket, Formula 1 GP2, Wimbledon Championship, etc., etc. These media rights were transferred by the US company to the Indian company. US company is ESS, in Indian company Star India Private Limited. So after the change in model, what happens is Indian company has these media rights for a particular geography, mainly India and other neighboring Asian countries. The advertisement revenue naturally flows to this particular Star Indian entity, and it has to pay to the sports bodies from which it gets the media rights. So earlier the US company, the Singapore branch would pay to the sports body. So if I take the cricket matches, so it was paying to say Cricket Australia, the Singapore entity would pay to Cricket Australia, Singapore branch would get the advertising revenue, and it would pay to Cricket Australia for the right which used to get for telecasting the cricket matches. And these are pretty big number, because if you see even this case, AY 15-16, the addition is around 2000 crores. Right? Now the media rights which were transferred were valued at $1,338 million USD. Yeah? And they were transferred to India at a figure of 1,211 million USD 1,211 million. So though the rights were valued at, originally purchased at 1,338 million, they were transferred to Indian company at 1,211 million. It's a discount of 9.5% on actual purchase price. Now what has really happened is this. So rights sitting with the US company, those rights have got transferred to Indian company. Now each of these agreements is a very detailed and beautiful decision. One gets time, should read it. Discusses how the media rights are flowing. For example, they discuss the agreement with Cricket Australia. What is the calendar of events? What are the tours for next 4-5 years? How many tests will be played? How many one days will be played? How many T20s will be played? What is the approximate license fee for each of these in each of the year? The agreement is signed by these agreements, which the US company had originally signed with all of these sports body, has spread in various years, 2008, 2010, 2011, and all of these get transferred to the Indian entity in 2013. Right? So those agreements had a table that each year how much you are going to pay. So though the agreement might have been signed in 2011, say for 5 years, the agreement itself, that means the agreement the US company signed with say Cricket Australia, provided year-wise breakup. So 2012, how many matches will be held, how much is the license fee? 2013, how many matches will be held, how much is the license fee? And so like this, each of the agreement very clearly provided that what is the license fee year on year for this. The SSC had bought this, then naturally the advertisement communicates, and SSC filed a return in India and declared losses. It did not have profit, it declared losses. Because you will be wondering why the media rights which are valued at 1338 million USD have been transferred at 1211 million. There is a discount from the actual price, right? So there is a value given in the license agreement. This is 1338, what I am telling is what the US company is paying to the sports body. And despite it paying more to the sports body, it is giving India at a lesser price, right? If you apply a prudence that it is giving at lesser price, therefore it should be at arm's length, right? So it's buying at 100 and giving it 91.5. So naturally it should be at arm's length. But this decision is all about that. And why it is not at arm's length. Now this license fee which the Indian company paid to them from assessment year 14-15 onwards, Star India paid to the US company, became an international transaction. Now it was a bundled agreement. That means all the agreements were transferred, all the media rights were transferred. It is like live it or take it. You either take all or leave all. It is not, you cannot select one of the media rights out of this. For example, there is a Champions League T20 cricket. If you all remember when IPL started, there was an opposite leagues started, but which never became successful. And the media right included that Champions League also, and you are making a payment for that Champions League also, which is not successful. So when the bid would have been made, it would have been a successful property for you to make a bid, but as you go down 2-3 years down the line, it is not successful, but you still buy it at the same price what the US entity was making to the sports body, right? So these were the dynamics of this, and they said either it's a bundled right, not a single agreement, it's a bundled right, and all the agreements have to be transferred, and the pricing was for the bundled rights. Out of this also there were tournaments which were successful, naturally fetched more property than what it would have normally fetched. That's also discussed in the decision. That is also discussed in the decision. Two situations of transferring this media rights have been discussed. One is novation of contracts and one is sub-licensing. So in case of sub-licensing, the US company has licensed from the sports body, say Cricket Australia. It sub-licenses that right to the Indian company. Indian company makes a payment of 91.5 to the US company. US company makes 100 rupees payment to the sports body. That is one set of agreement. Second is a novation of the agreement. That means the Indian company steps into the shoes of the US company. The agreement is novated, and Indian company will have a direct agreement with the sports bodies, right? So while doing this direct agreement, the Indian company, because now steps into the shoes of the US company, it will make payment directly to the sports body. So these both agreements are there. First edition happened in AY 14-15, second edition happened in AY 15-16. AY 15-16 is what we are discussing. In AY 15-16, an addition of 2000 crores was made by the transfer pricing officer. In the TP study report, the SSC adopted DCF valuation as a basis of analysis. It adopted other method. It did not adopt cup method. So we have 6 methods. Cup method, which compares the price. We have RPM and CPM, resale price method, cost plus method, which compares the gross margins. We have profit split method, TNMM, transactional net margin method. These both methods covers the net profit analysis. So we have price, we have gross margin analysis, we have net margin analysis. Other method which is prescribed in Rule 10AB, this method, it is not necessarily a method. The difference between 5 method and 6 method is 5 methods are based on actual transactions. So that means you really have to have a transaction and to do a comparability analysis, to do an ALP computation. But when it comes to 6th method, it could be a transaction which has been undertaken or proposed to be undertaken. This naturally arose because before the bringing in Rule 10AB, the difficulty was there will be always these kind of unique transfers of intangibles or similar other things which cannot be benchmarked. We will never have a comparable transaction. So if I transfer a media right like this, we will never have a comparable transaction. And TP analysis is always based on a comparability analysis. So they said, okay, you can use valuation methods, you can use quotations, and you can use something else, but all that will come under other method. Because other method, you can also see a transaction which is proposed or which is happened or which is proposed. That is the language used in Rule 1080, which borrows the philosophy from 92F+3 definition of arm's length price. Because arm's length price is also transaction which is undertaken or proposed to be undertaken. So based on that, the assessee used valuation methodology, DCF based valuation report, and concluded that what it has paid is 1211 million is at arm's length. Now 1211 million was not paid in 1 year. The agreement is in 2013, that is assessment year 14-15, but over the period of agreements, the payment keeps on happening. The decision also discusses that the media rights, because it is a year-on-year payment which has to happen to the sports body, year-on-year payment which has happened to sport body, the payments are also made year-on-year. So 30% or 40% is made before the sporting event starts, and the balance amount is paid based on certain terms and conditions. So every year a payment has been made. So it becomes a recurring adjustment for the assessee in case of 14, 15, 15, 16, etc. In 14-15, the similar addition was made. The assessing officer, the transfer pricing officer did was, the transfer pricing officer held that the valuation adopted by the assessee is not correct. He found out mistakes in the valuation, deficiency in the valuation. What deficiency? For example, assessee used the terminal value for valuation. We use terminal value in the valuation, right? In the cash flow DCF, we use a terminal value. The assessing officer had, these are finite agreements. That means there is a defined period. It is for 5 years, 7 years, 3 years, etc. If it is for defined period, how can you have a terminal value? The cash flow is only for that defined period. How can you have a terminal value? So let this, he found out mistakes in the valuation. After removing those mistakes, naturally the cash flow reduced and the adjustment came into picture. Same thing was replicated in AY 15-16 also. AY 15-16 in AY 14-15, assessee submitted further new valuation reports for the basis of valuation after correcting those mistakes, brought in certain experts reports, etc. before the tribunal. Tribunal has said that these are the additional evidences which are filed before me and remanded my matter back to the officer in 14-15. In 15-16, these all were before the assessing officer itself. The assessee took another argument now, saying that look, I have paid 91.5% and the AE has paid 100%. That itself is a cup method. Now it had selected other method in the TP study report. It had selected other method in the TP study report based on the valuation. But when it came to the transfer pricing assessment, it wanted to change its method. It wanted to change its method and adopt a cup method, saying that I have paid 1211 million, whereas the value that my AE is going to pay to the sports body is 1338 million. Therefore, I have paid 9.5% less, and therefore my transaction should be arm's length. Doesn't it appear to be arm's length at a first blush? Yes, naturally it appears to be arm's length because what my AE is paying to third parties, I am paying to AE which is lesser. So this was the argument which the assessing the assessee took before the transfer pricing officer, DRP, and the ITA. Naturally, the officer did not accept these arguments and he adopted the same valuation methodology adopted in AY 14-15 and made an addition of 2031.50 crores in the transfer pricing officer. DRP confirmed the addition. DRP asked one more aspect, that while doing a bid, how did you arrive at the bidding value? What is the basis that you arrive at a bidding value? The assessing officer and DRP brought and revenue before the tribunal have basically two strong arguments. One, that look, the tender has been taken in the earlier years. The bidding has happened in the earlier years for the media rights. So you would have my associated enterprise got the media rights in say 2011. And assessee is transferring these rights, or the rights are getting transferred to the assessee in 2013. There is a gap of 2 years, 3 years, in some agreements even 4 or 5 years also. The business circumstances might have changed in 4 years. The assessee is undertaking the obligation of the associated enterprise. So associated enterprise has an obligation to make a payment of 100. That obligation is now being taken over by the assessee. whether an independent party will in 2013 be ready to undertake the same obligation. For example, they give example of this Champions League T20 event. Now, this event is no more successful event. The advertisement revenue that you can get from this event is much lesser. Therefore, why would a third party undertake to pay the license fee of that event also, right? So whether there is a change in business and commercial circumstances, say from 2011 or 2008 to 2013, and just by saying that what my associated enterprise is paying to sports body, whether I also pay a lesser amount than a 9.5% discount, whether it is valid. Second, they said why 9.5% discount? Why not 10 or why not 2 or why not 5? What is the basis of determining 9.5% discount? Why not lesser or why not higher discount? So they had rejected this. So when it came before the tribunal, this was the question before the special bench. That whether the assessing officer, three questions are there basically. Whether assessee can change the method at a later stage. Assessee had selected other method in the TP report. Now he is claiming to apply cup method because there is a back-to-back arrangement, and he says that payment made by my A to the sports body is a comparable transaction, should be compared with me. So whether cup method can be applied, whether assessee can be change the method, whether cup method can be applied, whether that can be most appropriate method, and whether the computation of arm's length on this back-to-back basis is whether at arm's length, whether it is correct, and or whether the additions can be made based on the deficiencies in the valuation report as pointed out by the TPO and the DRP. So these were the issues which came before the special bench. It's a lengthy decision running into 130 pages, 140 pages. It's a split decision. There's a one member vice president has taken a different view. Second member, accountant member and a judicial member have taken a different view. So there are two views in the same decision. Naturally, because also the figure involved is large, it has further ramification, and when we have subsequent decisions by High Court or Division Bench, we will have interesting further understanding of this particular decision. But first point is, first we will discuss the minority decision. This is a minority decision. The second decision is the majority decision. So the vice president's decision is a minority decision. On one point it is minority, and one point the other judges also agree with this. First point is whether after having selected one method in the TP study, can during the assessment or before the tribunal, assessee come up and say that my method should be different? Can I change the method during the assessment proceedings? On this point, the decision of vice president is in assessee's favor. They can say assessee can change the method. There is a reasoning for that. I'll come to that. But basically, what the vice president's decision, or Sri Shial's decision discusses is that one, it is a bundled right. It is aggregation of all rights. It is not you can select one out of many rights, and therefore it is in bundled right, and aggregation has to be adopted. In terms of changing the method, they follow the decision of Delhi High Court in Matrix Cellular. Now, in the case of Matrix Cellular, what had happened is assessee had selected TNMM, benchmarking at the net margin level. While doing the benchmarking at the net margin level, assessee made an adjustment for capacity utilization. The assessee said my capacity utilization is at a lesser level, therefore some adjustments were made. Actually, it was a trading activity. I don't understand why capacity utilization adjustment was there, but anyway, that is what has been made. The officer naturally rejected the capacity utilization adjustment, and before the tribunal, assessee said I want to select RPM as the most appropriate method. So it was first time before the tribunal, assessee selected the RPM, resale price method, as the most appropriate method. Naturally, when you compare at gross margin level and net margin level, there will be difference, because gross margin may be better in some cases, because if you have higher operational expenses, net margin may be lower. So the tribunal accepted RPM as the most appropriate method because it was a distribution activity. Whenever there is a distribution activity, no value addition, RPM is the most preferred method. Settled principle by various high courts and tribunals and OECD, etc., that in case of a distribution activity, you should take resale price method as the most appropriate method. The High Court held that the mandate of the law under 92C1 is that arm's length price shall be computed by most appropriate method. Arm's length price shall be computed by most appropriate method. That means the mandate for all assessee, TPO, revenue, tribunal, everyone is that everyone should apply most appropriate method. So if the assessee demonstrate that the new method is a more appropriate than the method which has been selected in the TP study, nothing bars the assessee from adopting the new method even before the tribunal. We had a very old decision of a special bench in court systems, QAART court systems in Chandigarh tribunal. There the assessee had selected certain comparables, and before the transfer pricing officer he himself said that comparables selected by me were not correct. And the special bench in tribunal in that case accepted that argument, saying that ultimately we have to compute arm's length price. What is important is computation of arm's length price. And all these are just processes, selecting comparable, selecting method are all processes, and the end point is arm's length price. So when you have to reach at arm's length price, select what is most appropriate method, select what is more appropriate comparables, and this principle has been followed. And now this, because it's a special bench decision, it becomes settled that if need be, I might have selected a wrong method in the TP study for whatever reason, but if need be during the TP assessment, if you want to have a fresh look at it and propose a new method, it is permissible because of this decision. This now you have a Delhi High Court decision and a special bench decision, but the obligation, that is the burden of proof, is on the assessee to demonstrate that my earlier method is not good and the new method is as per the provisions of 92C read with Rule 10B and Rule 10C. That is the obligation and burden of proof on the assessee. If I can demonstrate this, I can opt for a new method even before the tribunal. Just leave before the TPO, you can opt it even before the tribunal. That is what the special bench decision provides. This point has been conquered in the majority decision also. So both the minority and majority decision concur with the view that assessee can resile from the method it has selected in the TP study and it can adopt a new method subsequently. Now, coming to next aspects, the concept of cup versus other method and which method becomes appropriate in what circumstances. It's a beautiful discussion on the concept of cup and other method, vis-a-vis cup and other method. Now, what do we understand by first 5 methods? And what we understand from 6th method, especially the cup method and 6th method. That comparison has been made in the decision. If you see the cup method, it relies on actual uncontrolled transaction. Vis-a-vis the other method, which does not rely on actual uncontrolled transaction. So when we weigh a cup method vis-a-vis the other method, the tribunal says, if you see the last point here, if a cup method is pitted against the other method, there is no price for guessing that it is the former, that is the cup method, which will prevail over the later, provided the comparable uncontrolled data required for it is available. So cup method will prevail over the other method if the comparable uncontrolled data is available. If you can demonstrate in any circumstances while doing a TP study or subsequently that there is a comparable uncontrolled data available, then the cup method is a preferable method when compared to other data. But for me to apply cup method, there has to be an actual transaction. Suppose I take a quotation or I have a general rate of bank of interest from SBI or something else or whatever. Those are not actual transactions. So I cannot select cup method in that. I can select other method for those cases. This is the distinction that we need to understand, that in a cup method I am going to look at the actual transaction. This is what the special bench decision brings out. So when I do a 3CB today, if I basically do not have an actual method, I have a close approximation which may be in terms of valuation report, which can be in terms of certain stock market quotations, or it could be something else, commodity quotations. Those, if they are not actual transaction, the method that we need to select in 3CB and TP study report is the other method and not the cup method. So the tribunal very clearly brings out the fact that actual transaction is what has to be envisaged in cup method. It further discusses the other 4 methods also, RPM, CPM, PSM, TNM, and it also says that even in these 4 margin based methods, what we are looking at is the actual transaction. No doubt we are comparing the margins in these cases, but what we are looking at the actual transaction. If there is hypothetical transaction or something else, for that the other method is a last resort which could be adopted. And when it comes to selecting first 5 methods vis-a-vis the other method, first 5 method, the preference should be given in the TP study for the first 5 methods vis-a-vis the other method. So these are the principles it brings out when we discuss the other method, which is the cup method. So it observes that though the statute does not give priority to any method, for selection has the most appropriate method, but the ambit of other method in contrast to the specific methods makes it a method of last resort because it is relatively lesser exactitude and meticulousness. So it is a method of last resort. You cannot take that method by default. We have to make an effort to see whether the first 5 methods can be applied in a particular circumstances. If those cannot be applied, then we can go to the 6th method. We can go to the other method. Then it analyzes the minority decision. First analysis whether the cup data for cup is available and whether the payment by associated enterprise to the sports body, whether that can be considered as a comparable uncontrolled transaction for applying the cup method. Okay, so what does the cup method envisage? It envisages a same or similar transaction entered into by enterprise or in uncontrolled circumstances or uncontrolled enterprise in uncontrolled circumstances. That is the starting point for me to apply a cup method. Whether there is a same or similar transaction. The cup method envisages same or similar transaction. So that's the first point which has to be seen. Now the payment made, the question that the minority decision addresses is the payment made by E to sports association or what it was supposed to make. If the media rights were not bought in by the Indian entity, this was the payment which the associated enterprise would have made. 1338 is what the AE would have made to the sports association. Because India has undertaken that obligation, now India is making payments. Some payments directly, some payments to the associated enterprise. So they say that it is a same or similar transaction because the same media rights, what A is paying to third parties, you are paying to the associated enterprise. So the condition of same or similar enterprise is satisfied. Same or similar transaction is satisfied. Second point, whether the argument of revenue that the year-wise, there is a change in circumstances because the circumstances when they bid for these media rights say in 2011 may be different for circumstances in 2013. The minority decision says that the year-wise rates are given. Year-wise license fee rates in every agreement, that what will be the year-wise license fee for media rights is given. Sports media rights has been given. It is not as if a lump sum payment has been made. It is not a case of a lump sum payment. It is a case of a year-wise payment which has been given. Those schedules are available in the agreement. And given that year-wise breakup is available, though it is a transfer of bundled rights, because the year-wise data is available, therefore, it is sufficient that the minority decision rejects the revenue's argument of difference in year, and it says that that can be taken as basis for calculating. It goes on to say that look, you have given a discount of 9.5% and therefore that itself demonstrates that it is arm's length. This is the minority decisions. Another two more points which comes out from this decision is it tries to distinguish ELP from fair value. The revenue argued that we need to see what is the fair value of these media rights in 2013 and not what the AE contracted to pay in 2011. And the fair value in 2013 needs to be evaluated based on the valuation which is done in 2013 and what an independent person would have paid for the same media rights in 2013. The minority decision says that fair value is not relevant for ALP computation because ALP computation is based on actual transaction and actual transaction can be different. The price in actual transaction can be different from a price in the fair value. It could be naturally different because if I do a valuation of particular shares, it could be different, and the way it is transacted today on stock market could be different, because it's a perceived that buyer and seller may have a different ways of looking at it. So that the ALP vis-a-vis fair value, it gives precedence to ALP, saying fair value is not relevant for TP purposes. And it is a aggregated approach, so don't look at one particular tournament and say that that tournament is not successful. Therefore, you can't say that everything has to be seen it differently, because one tournament may have not been a failure and other tournaments may be successful. Therefore, when it is a bundled transaction, look at the valuation on a bundled basis, not on tournament basis, not on a particular single media right basis. So this way, it starts to reject the revenues adjustment. It starts to reject the revenues adjustment of 2000 crores, and it is deleted in the minority decision. Now then comes the majority decision. The decision first is authored by the accountant member, the second accountant members, and he says, if you see the italics at the bottom of this slide, on the aspect of selection of method, that is whether the assessee can change the method, I agree with the decision of VP. So therefore, on the aspect of change of method, all three judges concur. On the aspect of change of method, that is, can assessee change the method in the TP proceedings, all three judges agree. And they say that ultimately we have to compute arm's length price. And 92C1's mandate is shall be computed applying the most appropriate method. And shall be means it is obligation of everyone to compute it correctly. So assessee can change the method. Officer also can change it, assessee also can change it. They say even if it comes before the tribunal also can do it. Okay. But if everyone keeps on changing, I don't know when the ALP will be computed. That's a different issue. But ultimately the right is there to change the method. So on that point, all the three agree. But when it comes to most appropriate method, the majority decision gives a different flavor. It says Y cup method is not the most appropriate method. Now, the assessee has, it basically reasoning comes in 2 to 3 main points. The assessee has entered into the agreement in 2013, which is called as Master Rights Agreement, as I've said in the first slide, MRA. The payment which assessee makes to the sports body directly or to the AE all emanate from that agreement, right? If that agreement was not there, assessee was not liable to pay, because that agreement is the genesis of the subsequent transactions. And with whom is that agreement? That agreement is with the associated enterprise. Now, when an agreement itself is with the associated enterprise, the things that are emanating from that agreement, it cannot be said to be an independent transaction. That are itself a controlled transaction and international transactions. So they say that the payment which are made to the sports body subsequently, either directly by the assessee or through the associated enterprise, that cannot be taken as separate transaction. If it is not a separate transaction, it is not a separate benchmark. And therefore, that is irrelevant consideration. And the main point which it is discussed in length is one single point, that whether in 2013 any other buyer would have paid 1211 for these media rights. See, the AE paid 1338 in 2011 or 2010, right? The question is whether someone else in 2013 would pay 1211 also, or he would pay more or he would pay less. And what would someone look at if a third party is purchasing these media rights in 2013? What will he look at it? What is the advertisement revenue that is going to come from this? What is my cash flow from this media rights? And if I pay so much amount in 2013, what would be the cash flow in next 5 years or 7 years or whatever it may be? No one is going to pay the same amount which is contracted in earlier years, for the simple reason that if I pay the same amount, if I incur losses, and here the fact was that AE was incurring losses and assessee also incurred loss subsequently after taking these media rights. Assessee also incurred losses after subsequently taking these media rights, right? So the main point which is highlighted in the majority decision is, in 2013, have the commercial circumstances changed? And it is quite possible the commercial circumstances may change. New technology may come, new things may come, the tournament may not be successful. There could be various things which can happen, which may a media property which was good in 2011 may no longer be good in 2013. So what you really need to see, the majority decision says, is in 2013, whether these rights would have fetched 1211 and whether a third party would be ready to pay these many amounts. And to do that valuation, you can't go by the control transaction. There is another transaction which AE paid to third party. That is a control transaction. That cannot be the basis. So there is no cup available. There is no cup available. And because this is a transfer of a unique intangible, this can only be valued under other method. Which can be only valued under other method. So they discussed the other method in detail and so what proposed to be charged was there in the other method. Various expert reports are available in these particular cases and the other method will become the most appropriate method. So majority decision highlights the view that other methods should be taken in these particular cases. So this is something which we have to understand that when I am doing the 3CB today, TP documentation today, cup vis-a-vis other method, what is the criteria for me to select cup as a most appropriate method or other method as a most appropriate or for that matter the other four methods. This decision gives a guidance in that sense that when you do not have an actual transaction, in your basing it on basis of certain evaluation reports, expert opinion, something more than that, in those cases other method will be the most appropriate method. When it came to the actual valuation, that whether TPO's action of changing the valuation, as I said, the terminal value was taken by the valuation. Now this is how the mistakes happen in the valuation. You would have used a standard template and given the figure, but there is no terminal value because it's a finite period. Its agreement is only for 5 period. How can it have a terminal value? This is what the transfer pricing officer said. Because those issues were not argued before the special bench, those issues are placed before the division bench to go into the valuation and decide whether the valuation is correct or not. The question before the special bench was restricted whether other method is most appropriate, cup method is, or whether the assessee can decide from the own method. So for us, these are the principles that we can draw under what circumstances the other method is the most appropriate method, what circumstances cup method is there, and if need be, if the assessments are going on, you need to change the method, one can change the method. So this is about the other method. This is also a brief discussion in the third member's decision. The main point he highlights that why someone would give a 9.5% discount. If the value was what is 1338, why would someone give a 9.5% discount? And anyone would not do it at a discount if it really was worth it at that. So this is a discussion in that. Then we come to a decision of Bombay High Court. Very interesting decision, and if this decision is upheld by Supreme Court, the most of the TP assessments will be time bound, which have been done till date or which are currently happening. I don't know if it gets upheld or not, but this is how litigation gets created in our country. We are a factory of litigation. We all know 144C, right? Dispute resolution panel. In TP cases, this is one of the important aspects which is there. In 2009, 1st October 2009, dispute resolution panel 144C was inserted. The reason it was inserted is there is too much of TP litigation. MNCs are getting impatient. The time limit to dispose these cases is very high, and therefore some certainty should be brought to the transfer pricing cases. So they inserted 144C with a defined time limit within which certain things should be done. So the assessing officer passes 144C1 says the assessing officer shall pass a draft assessment order before passing the final assessment order. The assessee has within 1 month, within 30 days, time to file objections before the dispute resolution panel as per subsection 3. Assessee files the objection, dispute resolution panel has 9 months to dispose those objections, and then it comes back to the assessing officer under 144C13. The assessing officer can pass a final assessment order 30 days from the end of the month in which the directions have been given to the dispute resolution panel. This was the scheme of dispute resolution panel. Look good. That is a panel of 3 commissioners. Possibly they will do a judicious analysis of what the TPO has done and give a fair decision. However, this section itself has created so much of litigation that for the whole purpose for which it was inserted is of, you will see that as split. First thing they missed out was connecting this to section 153. 153, as we all know, provides a time limit within which the assessment should be completed. 153.1 provides the time limit for completing the assessment. 153.2 provides a time limit in 147 cases if the cases are picked up for reassessment. 153.3 provides in remand back cases where the tribunal has remanded or some orders have to be passed post 263 or 264 orders, 12 months time limit has been given. 12 months from the end of the financial year when the order of the tribunal has been received. And 153.4 provides that if the additional time of 12 months can be given if the reference is made to the transfer pricing officer. These are broad provisions, we need not go to 5, 6, 7, 8. So this is a theory. Now 144C, though under subsection 13 of 144C overrides 153, but it never provided a time limit that within what time the draft assessment order should be passed. No time limit is provided either in 153 or 144C. The provisions have been implemented all these years, no one has bothered about it. The general understanding all of us had was that the 153.1 time limit read with 153.4 is time limit to pass a draft assessment order, and the time limit of 9 months plus 30 days given in 144C is the additional time limit which is available with the assessing officer and dispute resolution panel to pass the subsequent time limits. And we also, as we all know, the officer is going to pass the orders in the last month. Like tax audits get done in the last month, like it's the same way the assessing officer also will pass the order in the last month. I sometimes wonder if there were no due dates, no one would have filed return in our country. Right? So in this particular case, the assessment of 14-15, very interesting argument is taken that no time limit is provided for passing a draft assessment order. The time limit provided in 153 is the outer time limit within which all activities should be done. That means draft assessment order, DRP proceedings and final assessment order. All these should be done within the time limit provided in 153.3. Because 153.3 does not extend the time limit given under 144C. So if you see these facts, what has happened in this particular case is the assessee is having a rig which is used in oil and mineral exploration by ONGC. It is a foreign company and its rig is used by ONGC. Again, if you look at this fact itself, it is interesting. Now, we all know there is a presumptive taxation 44BB, where 10% of the gross receipts become net profit and 40% tax on that is the taxable income. So, you pay 4% tax on the gross receipts. This is the provision 44BB, right? 44BB3 gives an option that you can opt out of 44BB regime if the assessee chooses it. So, what happens is in a year of loss, I opt out of regime, carry forward the loss. In a year of profit, I opt in the regime and pay 4% tax. This was a practice which was going on for decades. In 2023, they have realized that this is a practice which has to be stopped and they made amendment in the statute. This is a case which is before that. Right? So, assessee in 2014-15 had a loss and it declared losses. It opted out by opting for 44BB3 and carry forward its losses. Right? Now, the assessing officer naturally realized that the earlier years he has opted for presumptive taxation, paid only 4%. This year he has losses, he is now opting it out. This is a statutory problem. What the assessing officer says, rejects the books of accounts, says your books of account are incorrect without giving any rationale, and straight away taxes 10% has presumptive profit, 4%, 40% tax on that, 4% of gross receipts becomes a tax liability, and makes the addition, running into some 200-300 crore rupees. Okay. So this is what the assessing officer did. The tribunal said you have rejected books of account without seeing anything, no evidence seen, no books, no mistakes found out in the books, however you rejected without seeing any basis. So they remanded back to the assessing officer. Assessing officer now, if the tribunal order has been passed in October 4-19, so that is financial year 19-20. If you go by the time limit in 153.3, you get 12 months to pass the remand order post the tribunal remand. It gets extended by 6 months because of the COVID relaxation and the time limit becomes 30 September 2021. The normal understanding was a draft assessment order should be passed before 30 September 2021. After getting the tribunal order, assessee filed multiple letters that kindly complete the assessment, kindly complete the assessment. The assessing officer was in deep sleep. He wakes up in the last month and then passes a draft assessment order on 28th September 2021. He passes the same order effectively, rejecting books of accounts again without looking at anything and makes the same addition. Right? Assessee files a writ petition to the High Court. Despite, he also files on a conservative basis, files objection to DRP also. 30th September is gone, the EO has not passed the final assessment order. The argument of assessee is simple. Look at 153.3. it says the time limit is 12 months. No doubt it gets extended to 18 months in this particular case because of COVID relaxation. Within 12 months, the assessing officer should have completed all the formalities of 144C, draft assessment order, DRP directions and the final assessment order. There is no time limit given for extending this extra time for DRP proceedings either in 153.3 or 153 or 144C itself. Okay. For this purpose, it relies on Madras High Court decision in Roka Bathrooms case, which said that 153.3 time limit has to be read into, 144C cannot get excluded for 153.3 time limits. Okay. The assessing officer has not passed the final assessment order. Naturally, if the draft assessment order is issued on 28th September, naturally by 30th September you can't pass a final assessment order. No way, because you file your DRP objection, it can't be done. So this was the argument that the assessee took before the Bombay High Court in a writ petition. After elaborate discussion, it's a long decision of 42 pages, discusses all the aspects. The point what the High Court says in single line is the time limit given in 153.3 is the outer time limit. 144C does not give additional time to the assessing officer to give pass and does not give that 9 months, 10 months extra for the assessing officer. Therefore, assessing officer doesn't get the additional time limit. The 153.3 time limit is the final outer time limit. It refers to 144C13, which says that assessing officer, 144C13 overrides 153, says that notwithstanding anything contained in 153.3, the assessing officer can pass a final assessment order within 30 days from the end of the month in which the directions are received from the DRP. But that is only for that extra 30 days, not for 9 months or 10 months. Okay? So this decision says that all these orders are invalid. There is a batch of appeals, all these orders are invalid. And 153 time limit is sacrosanct and 144C doesn't give you extended time limit. It discusses various aspects, like there is an explanation 1 to 153 which gives additional time limit in certain circumstances, but that doesn't cover 144C and various other things. If this decision were to be correct, all TP assessments are barred by limitation because most of the orders are passed in last month. If you calculate additional time limit which is taken before the DRP and passing the final assessment order, naturally based on this decision, all those time limits will be invalid. The revenue has gone to Supreme Court, and Supreme Court, in the last para of this slide, the Supreme Court has given an interim relief. The interim judgment shall not be cited as a precedent in any other subsequent matter until further orders. We also clarify that the operative portion of judgment shall apply only insofar as the respondents herein are in question. So to some extent, Supreme Court has stayed the decision in these cases. But Supreme Court has stayed the decision, but the rationale and arguments still remain. Right? If I have to make these arguments again before a court, it has to independently decide whether this way or that way. The point is the lacuna in drafting, where things have not been thought through, that if you are providing a new mechanism of passing a draft assessment order, which does not detail what should be the time limit for that draft assessment order, somewhere down the line, if someone takes these arguments, whether correct or incorrect, how big the damage could be. These cases itself have hundreds and hundreds of crores of additions. Right? All the orders would become bad in law if Supreme Court says to uphold this particular decision. Same happened with the 147 proceedings. If people remember Ashish Agarwal's case, right? They have made a change in the reassessment proceedings provisions, but issued notices under the old law. Now the section itself is not effective and you are issuing notices under the old law, right? There were roughly, I think, what Supreme Court said, 90,000 such cases. So look at the magnitude of loss the revenue would have because of some provision moved in a hurried manner without thinking through what would be the implications for that and what would the potential revenue loss for the country. That is the principle that is there. But anyway, for us, the principle here is if this decision were to be there in every pending litigation, this ground will be taken and most of the cases the orders will be bad in law. That is something for us to look at it. We have another 15 minutes, we'll quickly take another 2 decisions. This is again a similar case where a mistake is made by the officer, and we'll quickly see this and go to the next decision which is more interesting in terms of computation of VFP. Again 144C, draft order is passed, the section provides that you have to give 30 days to the associate to file the objection, right? In this case, draft order is passed on 3/12. On 14/12, the associate has filed a letter to AO that look, I am going to DRP, don't pass a final assessment order. Despite that, on 24/12, the assessment officer passed a final assessment order. Only 20 days has been given. The law itself provides 30 days has to be given. Now, before assessee got the 24/12, assessee got this order on 29/12. So 24/12 is the order date, 29/12. Assessee had already filed objections before dispute resolution. Against the new final assessment order, assessee filed CAT appeals and told the DRP that look, final assessment order is already passed, you don't pass any directions. The DRP did not bother about it, passed the direction. The assessing officer passed the second final assessment order. And against the second final assessment order, assessee filed a writ petition to the High Court before the Bombay High Court. The argument was simple. First final assessment order is passed, that is valid or invalid, that has to be seen, right? When the final assessment order has already been passed, the DRP has no jurisdiction to pass a direction. And because the DRP has no jurisdiction to pass the assessment, because 144C can apply if only if there is a pending assessment. And if there is no power to pass, give the directions, then a second final assessment order is binding law. Before the High Court, the revenue accepted that it is a mistake, the first assessment order is mistake. The revenue pleads before the High Court that if you quash these orders, then the first order is also invalid, the second order is also invalid, because first order is invalid because it didn't give 30 days time, second order is invalid because the order was already passed. So both the orders will be invalid. I can't, what you have to save the revenue. High Court said nothing doing. You have made a mistake, and they discuss these principles, which are a very interesting principles which should be used. And both the assessment orders, in all probability, will go. So what principles are discussed? Taxing statute must be interpreted strictly. Equity has no place in taxation, nor while interpreting taxing statutes, entailment would have any place. There is nothing unjust in taxpayer escaping if the letter of law fails to catch him on account of the legislature's failure to express itself clearly. It is axiomatic that taxation statutes has to be interpreted strictly because the state cannot at their whims and fancies burden the citizens without authority of law. The matter of interpretation of charging section of a taxation statute, strict rule of interpretation is mandatory, and if there are two views possible in a matter of interpretation of a charging section, one favorable to the assessee should be applied. So these are the principles which the Bombay High Court discusses. Last decision which we will take is the Finolex cable. We were discussing the concept of ALP computation in the case of SDT. Now, the assessee in the concept of a tax holiday undertaking may have multiple undertakings. It may have one undertaking which is a tax holiday undertaking, say it is placed in a SEZ unit, and it may have other undertaking which is non-SEZ unit. There may be common expenses within this SEZ and non-SEZ units, like a management fee, etc. Right? Or there could be a corporate office which is separately there, and the cost of that corporate office will be something which will be there. When we calculate the profits of SEZ unit, while calculating the profits of say SEZ unit or any other tax holiday undertaking, the common cost has to be allocated. The assessee in this particular case had an rookie unit which was eligible for 80 IC, and it allocated the common cost on the basis of turnover to that particular unit. The assessing officer says that common costs only have been allocated, you should have charged a markup and allocated. That means you should charge a markup of 7.48% based on certain set of comparables, and you should have allocated even that markup also. The assessee's argument is only the allocation, that is the cost which has been incurred has to be allocated. So today when I do this SDT transactions, if I have a tax holiday undertaking, the common cost which has been allocated, whether markup is required or not, is what has been discussed in this particular decision. The question which this decision answers is, when you have this common cost, is one unit rendering service to other unit, or it is a common cost? There is no service rendered by that other unit to this unit. There is no service rendered by that other unit to this unit. It is just a common cost which is allocated. And when there is no service transacted, when there is no service rendered, in these cases the question of markup does not arise. A bare minimum allocation of cost would be sufficient. What this principle drives is, even in other cases where there is an allocation of expenses, we do a lot of cases where the allocation, group allocation of expenses, right? You would incur the costs and costs will be allocated. If those allocation of expenses are without any markup or without any markup, if it is from say India side, if you are rendering in, you are charging to a group company, cross charge is made to a group company because cost is in India. The point is where it is just an allocation of expenses between the common concerns or group concerns. In those cases, markup may not be required, because if there is no rendering of services involved in those cases. Only where specifically services are rendered, the question of markup will come. This is a point that which we can draw from this particular decision. So this was the last decision I thought which would be relevant for our discussion. So if there are any questions on what we have discussed or any other questions related to transfer pricing, I would be happy to take and we can deliberate on this.
Ultimately, what is the method that has been adopted in starting at this recent?
Majority decision said other method. So other method has been what the tribunal has concluded. That is the most of. So other method will include the DCF. Okay. So statute provides 6 methods: CUP, RPM, CPM, TNM, PSM, and other method. Now other method is a residual method. So the valuation in terms of DCF or quotations or commodity exchange prices, all that fits into the other method. So the valuation reports were all based on DCF. There were 2 valuation reports, another one expert's opinion. All those were based on valuation report. And one of the points which valuation report also highlighted, valuation reports normally discuss this cost approach, income approach and all. They said cost approach cannot be taken in these cases and income approach is what should be taken because it's a discounted cash flow basis, and then they go into this. The tribunal also discusses these valuation reports and say that when the experts have itself said that cost approach is not feasible, then why we should consider the cost given by A to the sports body. And when they themselves have said that valuation based on discounted cash flow is more acceptable, therefore the valuation, DCF based valuation method under the other method is what should be taken as the most appropriate.
But why not the resale price method, which is more
No, see, resale price method will come where I purchase from associated enterprise and sell to third parties. So the condition for applying a resale price method is you have to purchase from associated enterprise, sell to third parties. For example, I import say mobile phones and then sell it in the Indian market. So these are the circumstances where resale price method will be applicable. There should be no value addition. It is a pure distribution activity which the resale price method happen. In this case, it is a license right which I get it. There is no lease sale or license wise. Because ultimately, my revenue will be advertisement revenue. Ultimately, what I will get is the advertisement revenue. So therefore, resale price cannot be applied. Resale can no doubt be of services also, because you see a lot of AMC being resold. So it could be resale of goods or services. There is no problem if the resale is of services. But it has to be a resale. That means I purchase from A and sell it to third parties.
So, sir, this other method like adopted the DCF, wherein this marketing rate, sponsorship rates were valued in 2013, wherein there's lapse of time and by that time the assets could have got impaired or not.
It could be either positive or negative depending on the circumstances.
So when we apply this new method, there could be various grounds for challenges, like you have adopted a different discount rate, you have over discounted it, or so we can expect these challenges.
Yes, you can expect these challenges, but when it comes to transfer of unique intangibles, unfortunately no one has any other choice because there will not be a comparable transaction. When I transfer either purchase or sell in unique intangibles, I cannot apply a margin based method. Very difficult to apply a margin based method, and I cannot apply CUP because every intangible will be different. And naturally, when I adopt a DCF method, everyone has a different perspective in terms of valuation. That we are seeing in 56 to 7B also, 56 to 10 also, all these cases have been coming. In the TP's context itself, there are two very old decisions. Tally Solutions case, where a intangible, the rights in Tally software was sold to a Dubai entity and the addition of around 500 crores were made. And the valuation methodology has been discussed, what would be beta, what would be this, why it should be taken, what would be the numerator, denominator. A lot of aspects have been discussed in that particular decision. Similarly, there was a DQ International's case of Hyderabad terminal, where Jungle Book rights to the Jungle Book program were sold to a Singapore entity. So these decisions have discussed, but very rightly put, these questions will come. These questions will come and it's a different perspective. That's why in this particular case, assessee has given 3 to 4 valuation reports. 2 valuation report, 1 expert's opinion, all have been placed before the tribunal and all. So one has to see how this decision, because now the valuation aspects are not discussed, TPO's arguments and deficiency of valuations have not been discussed. Those possibly will have a division bench decision discussing these aspects, and then we will get more insight into this. Same controversy is for share valuation and other things. Same controversy will arise for this also. But unfortunately, we have no choice. We have to go by valuation methodologies for these kind of transactions.
So the first case where the ESS US entity has won the bid for 1338 million USD. So the second bidder would have bid for, assume that 1,300, 13300. Will that be treated as COP?
That could be, but the argument which the revenue has made is the circumstances have changed in 2011 and say 2008 and 2009. The bids are in 2008, 2009, 2010, 2011 and 2013. So say for example today TV rights might have been sold at a particular price, but with the advent of mobile, suddenly the TV rights may not fetch the same value subsequently. And we have seen the recent bidding where digital rights are more valuable than the TV rights. Right? So these circumstances, the question is whether the circumstances have changed from 2011 to 2013. Revenue will have that obligation to demonstrate that the circumstances have changed. The economic and business rationale have changed in these two cases. That is something revenue will have to demonstrate, and assessee will have to show that the circumstances remain same. If circumstances remain same, then there is naturally no reason for me to change the figure. But if there is a new economic circumstances which is coming, could be some changes, we never know what would be the change. If that be the case, yes, there will have to be relocated. So the question that the majority decision rightly puts, will a third party buyer in 2013 be ready to pay the same amount? If I believe that these rights today, if these media rights were not going to fetch me enough revenue in future, in terms of advertisement revenue, and I am not going to be a positive cash flow in future, then whether I would buy these rights or not.
That
And
is
either
a hypothetical thing.
this is hypothetical, but how would a third party look at these rights? So in 2013, when he look at these rights, he will look at the circumstances in 2013. Suppose I have a right of, suppose it was a single transaction of Champions League T20. My AES paid it in 2008 or 9 whatever, and I want to buy in 2010. I am going to look at it. Today this media property is of no use because there is no media buyers for this particular event. Then I will not pay the same price. But this is a bundle transaction. You can't segregate one single item out of this. You will have to look at all this. The question is whether these are having a similar economic and business realities in the subsequent years also. I have to match those economic and business realities in different years. If those remain same, I would feel that the price paid by A is still a good bet.
Okay, going by the same analogy, so you said that, as we have seen that only 2020 assessment year assessments have been concluded. So now we are moving to 21-22 assessments where the COVID affected year has been picked up.
See, if you look at the notices what have been issued for 21-22, at least for these segments, software, ITES, they in fact have a higher margin. Because at least in the first year, though not all, but the companies which were able to have work from home, they reduced their costs because of rental cost, or even the employee, there was no attrition at that point of time because everyone was worried what is going to happen in future. So there have been no reduction in the margins in the 21-22 assessment, at least for these segments. I am not saying for all, because manufacturing, auto industries, tourism industries, those naturally suffered a lot. So those, for these segments, they have not come up with any reduction in margins in the notices which have been issued in 2021. So in terms of COVID, if the assessee is maybe impacted, so one, that will be a factual exercise. For example, I will give, we may have a cases where you are developing software for tourism industry, right? Naturally the circumstances will change because that industry got affected the highest. Whereas doing a software for say IT infrastructure, because that was the most highest requirement at that particular point of time. Gaming or media things, OTT things. So those had a very better situations. So one, in the assessments, we will have to factually project that my industry or my SSC was in such a cases which had a higher impact of COVID. So I lost projects, my AE lost projects, he had lost projects, so money did not come, bad debts were there. So those were factual things which will have to be brought out in the submissions, case to case basis.
And the receivable part, where because of COVID, a lot of they don't even the SSC can argue that because of this the receivables have been
Yes.
paid and there is no application of that to.
So in a normal circumstances, what they are taking should not apply for assessment year 21-22 and 22-23 because there were 2 years when naturally everything got deferred and people had deferred the receivables also. So those are at least very valid argument for those cases. Very valid argument. So any other questions? So thank you everyone for patient hearing and thank you for wonderful questions also. Thank you everyone. Thank you.
Members, as we all know that change is the only word constant, and keeping ourselves updated, be it with amendments if any, or any new circulars or case laws with regards to compliances which we are heading towards. It was a good 2-hour session, sir, on recent developments in transfer pricing. Can we all give a big round of applause for the experience and expertise in the subject which was developed upon by CA Narendra J Jain. On behalf of members present here and all the managing committee members of Bangalore branch, we would like to hand over a token of gratitude to the Lord Speaker. Can I request CA Anturaj sir to come over to dais and then hand over. Thank you, sir. Members, thank you for your support for Bangalore branch. Keep supporting Bangalore branch. Thank you. Good night.